The pandemic-induced economic crisis has necessitated banks to shift focus from growth to preserve capital, manage portfolio stress, reduce costs, and maintain adequate liquidity in the near term. City Union Bank, a mid-sized private bank's performance in the current fiscal year definitely reflects this change in strategy. Now, contrary to most banks that have actually guided for better growth in the second half of this fiscal year, City Union Bank still intends to continue with the strategy of balance sheet protection and will revisit the strategy only in March 2021. In our Ideas for Profit today, we'll discuss why should one really keep an eye on a regional-focused mid-sized bank. Well, in the current times, one should definitely focus on consistency rather than, say, growth or size. City Union Bank is perhaps the only one of the old private sector banks in the country that has a long track record of profitable growth from the last decade onwards. Now, its performance is marked by stable profitability with return on assets of more than 1.4% for the past 10 years, and that is just except FY20, and reasonable asset quality across credit cycles. Now, the bank, with its focus on balance sheet, is better placed to navigate through the challenging times as well. Also, City Union Bank's total advances have stood at 35,437 crore rupees. And that's at the end of September, recording a growth of, say, about 6% on a year-on-year basis. Also, around 50% of the bank's loan book consists of lending towards MSMEs and of traders as well. Now, the pandemic has really disrupted the cash flows of these small businessmen. Now, to support these, it has extended the government-guaranteed ECLGS loans up to October 20. Now, if you see, the strategy of focusing on ECLGS and gold loans has already started to yield benefit for the bank and has led to improvement in the capital adequacy ratio to 17.36%. Now, the total deposits increased by mere, say, 2% on a year-on-year basis to about 41,421 crore rupees. The bank wants to keep deposit position muted to protect the margins. However, if you see, the bank still maintains the strong liquidity over here, and the retail deposits have accounted for about 75 to 85% of the bank's total deposits, and that's during the past few years that we have seen. Thus, the lending stability, it has been lending stability to the overall resource profile. Now, what we are enthused by is the fact that the bank has no reliance on the bulk or the corporate deposits. The share of the low-cost CASA deposits is 26% of the total deposits, which is much lower than the industry average as well. Now, the bank's lending focus is much more on the working capital loans, which actually constitutes about 59% of the advances, and that is at the end of September that is seen. Moreover, it also targets the lending to trading and MSME segments in small ticket sizes as well. Now, hence, the bank really enjoys relatively higher yields on advances, and that's mainly driven by the small ticket loans to SMEs and also to the product mix that is tilted towards the large working capital facilities that earn relatively higher yields when you compare it with the term loans. Now, the bank reported net interest margin of 4.12% in the last quarter or the latest quarter, that is Q2 FY21. Now, the bank has maintained the spread between cost of deposits, yield on advances in the last 10 years. Now, collection trends are seen to be improving going forward. However, of the total exposure, the borrowers constituting about 4% of the total loan book have not paid even a single installment. Bank is now expecting about a 5 to 6% of total book getting restructured, which is on a higher side. Now, bank's provision coverage ratio also stood at 70% as on September 30th of 2020. However, the slippages could now increase due to COVID-related stress and higher restructuring of assets as well. Now, the management has guided for elevated slippage ratio of, say, 3 to 3.5% in FY21. The stock has also rallied about 40% in the past 2 months as well. Now, consequently, the valuation is full now, with the bank currently trading at 1.8 times FY22 estimated book as well. Now, we do believe that the bank's stable performance, and that's across the credit cycles, and conservatism, they all justify the premium at which the bank is trading or the stock is trading at a time when the banking sector is grappling with major and multiple issues. Now, investors looking for a, say, stable, safe bet in a highly uncertain market can definitely go for an accumulation of this stock on dips.